Don't forget to download Simpler Budget today. And to learn more, go to simplermoney.com. Taking control of your financial future can't wait. Start now with your Simpler Budget.
Hey, congratulations, you graduated college. Or maybe you're just thinking about college and excited at the thought of learning a lot and eventually landing your dream career. You might be in college right now wondering what exactly will come next for you, or simply enjoying the moment. But stop! Did you ever think about those loans you're taking out on your debt? Because, yeah, those are about to be a big problem. Student loan debt is the second largest consumer debt category behind mortgages. And the tragic part is many of us don't even use this to our advantage, because over 32% of undergraduates don't graduate. And no, this isn't isolated just to the few. 43.4 million Americans are carrying this debt burden, with a collective $1.63 trillion in debt. This really isn't entirely our fault. Over the past 60 years, the cost of college has tripled, growing 8 times faster than wages, with the average balance on a federal loan reaching $37,718. Not sure who thought it was a good idea to give 18-year-olds access to that amount of debt. And recently, this sentiment is changing, but in our society, a college degree has been viewed as the key to unlocking financial wellness. And with college grads earning 67% more than their peers on average, it might be true. Unless you're in fact that 32% that doesn't graduate or decides not to apply their college degree or education. Now, this is all very scary, but death by student loans doesn't have to be your fate. In fact, for most of us, our student loan payments are likely well within our means. By applying the right tools and taking the right actions, we can get these paid off and properly managed in reasonable time. If you haven't taken on student loans yet, then you're in great shape. There are many things you can do to avoid the fate of those 60 million Americans. Let's get into the type of loans that you can take out and go from there. There are 2 general types of loans: federal loans and private loans. Simply speaking, federal loans are backed by the United States government and private loans are not. Federal loans account for about 93% of the student loan market, while private loans account for the other 7%. And there are good reasons for this. Federal loans provide many protections that private loans just don't. First, the terms are set by the government and by law, so you always know what you're getting into. Federal loans also tend to have lower interest rates and more consistent terms. Some are even subsidized, which means that you aren't accruing or paying interest on those loans while you're in school. That can save you a ton of money over time. Say you graduate and need to start paying on these loans and don't have the income to meet the minimums. You're in luck, because there are different income-driven repayment plans and payment options that can make your student loan burden easier while you get back on your feet. So if you only have these public loans, congratulations. You've given yourself a bit of grace and avoided one of the largest pitfalls, which is the private student loan industry. As mentioned, with public student loans, there are many payment options, but the best one to save you money is clearly the standard repayment plan. Now look at your situation and determine what's right for you, but for most of us, it doesn't get any better than the standard. With this plan, you'll have your student loans paid off in 10 years, and you'll do so at the lowest interest rates. This means you'll not only pay the least amount over time, but you'll be free from student loans quicker. But before you start paying on these loans, make sure you check and see if you qualify for any student loan forgiveness under the PSFL program, Teacher Loan Forgiveness, or an income-driven repayment plan. PSFL, or the Public Student Forgiveness Loan Program, is built for public service workers employed by the government or a nonprofit. The Teacher's Forgiveness is built for teachers, as the name suggests. And you may qualify for this program if you work in a low-income area or for an educational service agency. Qualifying for these programs can be difficult, but I've included links below this video so that you can look into each program. There's a lot of unclaimed funds out there, so if this sounds like you, be sure to apply. And when it comes to federal loans, you can also pay these off quicker. But there are pros and cons to doing so. Paying off your student loans fast can take a major burden off of your back and frees up a lot of your money. But because of compound interest, the earlier you can start investing, the more money you can have later in life. Consider paying off your student loans earlier so you can take that money, invest, and secure your financial future. But if your loans are under 5%, you may want to pay the minimums under the standard repayment plan and then invest the rest. This is because the S&P 500, which represents the 500 largest stocks of the United States, returns an average of 8 to 12% a year, all up years and all down years combined in its history. This means that it could be more beneficial to invest any extra money into the stock market instead of putting that towards paying down your loans. Now, if you're just taking that money and buying Starbucks, then you aren't getting any benefits, my guy. Kind of recently, Joe Biden announced a new student loan repayment program called the SAFE Plan. Now, it is being challenged in the courts, but essentially this income-driven plan would lower your payments to 5% of your income, and you would not incur extra interest by taking this option. For some borrowers, you could even have your student loans forgiven in as little as 10 years. So anything you don't pay will be forgiven. I don't recommend this plan for most people because for the average borrower, it would take you 25 years to reach forgiveness, meaning you'll just be paying your student loans for a longer period of time. 25 years is far too long to have this kind of debt. So pay this off in the standard 10-year period and live the rest of your life debt-free. If you have $12,000 or less in student loan debt, that won't be paid off in 10 years under this plan, so this could be a great option for you. Now, if you're struggling to pay off other debt, such as credit cards, car loans, then consider the SAFE Plan for temporary relief. It could help. But let's talk a little bit about private student loans. Private student loans don't offer many of the same protections that the federal student loans do. The interest rate on these loans vary widely, with some being as little as 3% and others being as high as 14%. Private loans can also have variable interest rates. So this means that you could be paying much higher interest in the future as you aren't guaranteed the rate you signed on for. Some variable rates can start as low as 1%, and they look enticing, but be aware because you're taking on a big risk by allowing these to increase in the future. Private lenders can also require you to make payments while you're still in school or to establish credit and get a cosigner to get approved. This could mean taking on more debt or putting friends and family on the hook for your high interest loan. Talk about an awkward family dinner. And with private loans, make sure you know and understand the terms of your loan because of how much they can vary by lender. Are you paying high interest? Do you have a variable rate? If so, consider refinancing with other online lenders which take on your loans for a lower interest rate. Once you get the best repayment plan for your situation, sit down and take a look at your income. Are you making as much as you can to pay your loans? If not, ask for a raise at your job first and see what comes of that. Studies show that switching jobs has a far greater increase on your salary, unless you work for me, don't do that, I'll punch you, than moving up with the same company. If you've been at your current company for a couple of years and are ready to switch, consider taking that leap. Unless you work for me, I'll punch you. I advise asking for 10% more than your current salary, at least when you're looking for a new job. And certification programs and trade schools can also be tools to increase your income and put those extra savings towards your student loans. Alternatives to college, by the way, are everywhere now. From UI, UX, and product management programs that can get you into high-paying tech careers to even more traditional trade schools which have been gaining in popularity over the years. As a matter of fact, mechanic and repair trade programs saw an enrollment increase of 11.5% from spring 2021 to 2022. All right. So far we've gone over what you can do if you're already in debt, but what if you haven't gone to school yet or are in the middle of college? In that case, there are plenty of ways to get that education you need without being a subject to the fate of most Americans. First, college can be fun and enlightening, but remember that this is a costly commitment even though you haven't paid for it yet. If you're in college, figure out what you want to do after school quickly and determine if your loans are worth that to you. Many experts recommend that the totality of the loans you should take should not be more than your expected first year salary. So if you're expecting to make $60,000 in your first year, don't take out more than $60,000 in loans. Look up the average salary of your expected job online and figure out where you might land. As a first year employee, you'll most likely land lower in that expected range, so don't assume the average or median immediately. Take advantage of lower cost options like community college. Remember, where you go to school has minimal effect on your earnings, so take advantage of those cost savings in the first 2 years. You'll have plenty of time to get the full college experience in your junior and senior year, so save the money now. And if your loans are unsubsidized, that means they could accrue interest as soon as you take them out. And due to compounding, this can dramatically increase your student loan amount. Try and pay some of this off while in school if you work or have some savings, or use that amount to invest if your loan percentage is under 5%. Cap out your federal loans first and think carefully before taking out private student loans. If you're in a position where you're forced to take on private loans, this could be a sign that you're spending too much on your education. And if this is you, reconsider your school or program of choice. And lastly, remember, you aren't stuck relying on just student loans to pay for education. There are many grants and scholarships offered to students by a variety of organizations. You'll likely qualify for a lot of these. Take the time to look up scholarship opportunities online and apply for as many as you can. This process, like getting a new job and many other things, should be treated like a full-time job. And if you're a parent, start saving for your kids' education now. Education savings accounts and 529 plans have many tax benefits and can allow your kids to go to school worry-free. Talk to a trusted financial advisor or do some research online to learn more about these plans. Hopefully this video gets you a strong foot to securing your financial future. And if you want to be able to budget your education properly, make sure you download the Simpler Budget app and join Premium for even more education.
Download the Simpler Budget app today and take control of your financial future once and for all.